Hi everyone, I'm very pleased to welcome you to our first global webinar on ESG and the future of sustainable finance. To introduce myself, I'm Olaf Clemens. I'm a partner in Capco's Frankfurt office and I'm Capco's ESG lead. The fact that so many of you have joined us today underlines just how important ESG has become today and what a critical focus it is for the financial industry and other market sectors. We are truly at an inflection point. Environmental, social, and governance principles have made their way from often being a nice, catchy phrase for marketing or communication purposes to regulation, informing business decisions, corporate investments, hence impacting the world of business and commerce with the intent to save our planet for the next generations to come. As you have seen in the invitation, we would like to make this webinar as interactive as possible. Therefore, I would like to encourage you to use the chat function in our GoToWebinar application to send us your questions. We will do our best to cover as many of your questions as possible during our Q&A session at the end of the event. It is my pleasure now to introduce you to the co-host today, Harald Glander from Simmons Simmons.
Thank you very much, Olaf. Just quickly, my name is Harald Glander. I'm a partner at Simmons Simmons in the financial services and funds team. I'm very delighted to be here today and welcome all of you to what promises to be an extremely exciting discussion. The intention of the regulation, of the EU regulation on ESG, is to incentivize the redirection of capital into sustainable investments, which of course will have an impact on the real economy. Now, a study of Bloomberg on the asset management industry recently shows that we're on good track to exceed 53 trillion of ESG assets by 2025, which would then mean a third of the global AUM. However, as Olaf notes, ESG is also being redefined currently. To date, of course, the focus is more on the E of ESG, but we are seeing that social and governance considerations are constantly becoming more of key priorities of everyone. Now, we have some challenges here. We have some challenges. Consistency and interpretation of the regulations, implementation of the relevant processes, and of course, on metrics and available data. So all of these things, amongst others, I look forward to discussing today with the distinguished panel. Quickly to introduce the panel, Jennifer, starting with you. Jennifer Wu is the Global Head of Sustainable Investing at JP Morgan Asset Management and leads the bank's Sustainable Investing Leadership Team, a global team of senior leaders focused on sharing best practices for sustainable investing across asset classes. Prior to joining JP Morgan, Jennifer also worked for the Asian Development Bank, where she focused on infrastructure, project finance, and policy reform in the energy sector. So a real expert in that field. Jennifer, very, very pleased to have you here today. Then let me introduce you to Steffen Hörter. Steffen is the head of ESG at Munich Re Investment Partners, the ESG-driven systematic investment management specialist of Munich Re. From 2008 to 2020, Steffen was a member of the EU Technical Expert Group on Sustainable Finance advising the EU Commission. Olaf, over to you.
Thank you so much, Harald. And it's my pleasure to introduce Ioannis Ioannou. He is currently Associate Professor of Strategy and Entrepreneurship at the London Business School. And being a professor and an advisor and a keynote speaker on sustainability, leadership, and corporate responsibility, Ioannis is a leading authority on how companies strategically integrate ESG factors into their processes and structures, and how the investment community perceives, evaluates, and reacts to such corporate attempts to integrate ESG. Pleasure to have you here, Ioannis. Then, Merzat Mahdavi is the Executive Director of the Financial Data Professionals Institute, providing chartered designation for the financial professionals working in the fast-growing fields of AI and data science. Merzat is a technology entrepreneur with a focus on breakthrough digital transformation for the fintech, energy, and industrial sectors. He served in executive management roles at Fortune 500 companies and startups, and he is a recognized expert on the application of AI, data science, the Internet of Things, and cloud computing. And it's a real big pleasure for you, for us, having you here in the panel, Merzat, because it's very early in the US, and thank you so much for making yourself available. And last but not least, Carsten Löffler. Carsten is Managing Director of the Green and Sustainable Finance Cluster in Germany, a private-public collaboration to foster sustainable finance in Germany. Carsten also chairs the Sustainable Finance Committee to the German federal government, and he is a member of the European Union Commission's platform on sustainable finance. In addition, he heads the United Nations Environment Collaborating Center for Climate and Sustainable Energy Finance at the Frankfurt School. Very big thank you to all panelists already at this point in time to making yourself available. Let's start. For example, taking the 2015 Paris Agreement as a key milestones, I guess not too many of us would have assumed that ESG and the underlying regulation would have such an effect on the financial services industry as we currently see. Carsten, as you have very closely accompanied this process in Europe over the last years, would you mind giving us your perspective on how ESG has developed over the last couple of years? And why do you think is the financial services industry now at the epicenter with immediate consequences for the real economy?
Many thanks, Olaf, for this question. Actually, as you mentioned, 2015, the year of the Paris Agreement and actually of the UN Sustainable Development Goals, just 2 months earlier, was an inflection point to some extent. I would say for many market practitioners, it actually was. But certainly quite a number of, in particular, larger and maybe more progressive financial institutions already embarked at that point in time to the ESG roadmap. And having said that, it's very important to understand why that is. So already before 2015 was a Paris Agreement, there was quite some obvious clarity that ESG will become an ever more important aspect in financing, both in capital market and financial markets more broadly. And starting from that, the European Commission took the initiative by 2017, 2018, very impactful, I have to say, by establishing the high-level expert group on sustainable finance, what was an industry group, industry experts, in particular from the financial sector, advising the European Commission on a roadmap. And that embarked into the 2018 Action Plan on Sustainable Finance. It's now 3 years old, and by next week, very likely, we will see the updated version, the European Renewed Sustainable Finance Strategy. So it's very interesting what has started in Paris and before, and moved on to 2017, 2018, with some activities on the international level with the Financial Stability Board of the G20, with Mark Carney, a very prominent role taking there, with the TCFD, the Task Force on Climate-Related Financial Disclosures recommendations at that point in time, roughly. We are now at a stage where I only can say there's no other way as to reflect ESG criteria in everyday financial market practice. If it's banking, investment management, asset owners alike. So it's there to stay.
Mm-hmm. Thank you so much, Carsten. And Jennifer, what is your view here, if I may ask? You have accompanied the development of sustainability over the last couple of years in your day-to-day business, for example, at BlackRock.
Yeah, so thank you so much for this question. I think the biggest change in the last, let's say, 5 years from an investment standpoint, and this is, working as an asset manager at BlackRock and now JP Morgan, all doing sustainable investing, interacting with asset owners, and then also other type of investors. I think the biggest change really is the understanding of how we can use ESG, and then also what
Okay, we should be good to go. Jennifer? Can you hear us again?
Can you hear me now?
Now we can hear you again, yeah.
Okay. Apologies for that. I don't know what happened. The mute button suddenly just went on and I couldn't unmute it. What I was saying is that I think the biggest change really is the recognition of how ESG can be used and what ESG is. What do I mean by how ESG can be used? I think there's a better recognition that ESG is more than just values alignment, right? So it's more about what do I believe or what do I like or dislike, and as a result, I can decide what I want to include in the portfolios. A lot of that I think is very primarily driven by if I don't like a company, if I don't like a sector, my only way of doing ESG is to exclude from the portfolio. So more like punishment. But I think a big change or two big changes in that is number one, you could actually stay invested or invest in companies that you think are really trying to provide products and services to help to solve some of the largest world problems like climate change, for example. So that's, you know, really moving from exclusionary to what we call, you know, tilting or inclusionary. I think the other big change is by staying invested, you can actually use your influence as shareholder or bondholder to do engagement, right? And even if it's companies that you believe that they need to make more changes, improvement, be it on the human resources and human capital side, or with regards to decarbonizing their own business mix, you can actually, by way of engaging with them, to help to push for that change. The other aspect of it is a better understanding of what ESG is. So I think, you know, from where we were traditionally thinking about ESG really relates to certain types of values, to now really looking at ESG as data and information. So what that means is that moving from what we call values-based investing to the traditional value investing. And what is value investing? Effectively, you're trying to look for risks and opportunities in companies across different sectors. And if you're given new types of information that are relevant to the company, then it's easier for you to identify risks that you never thought about, or to be able to better understand how a company is doing on some of the traditional issues that you would want to be looking at. So one example is you could use, for instance, external data from alternative sources to understand how a company is treating its employee, right? Be it by using data science to look at LinkedIn data or what. And you could also get NGO data to get a better understanding of how a company is managing its governance issue. So all in all, I think the understanding of what ESG is a lot broader than what it used to be. And I think that's really the biggest change that we've seen in the last 5 years as investors.
Thank you for that, Jennifer. And I think that's a pretty nice segue into the next question. I mean, as lawyers, we really like to work with definitions, yeah. So we are having lots of interpretation issues at the moment. What is an Article 8 product? What is an Article 9 product? What are sustainable investments under the SFDR? What is an environmentally sustainable investment under the taxonomy? I mean, all of this can be highly complex, but to one extent also quite technically, and we need to see this overarching goal of all of this, and it serves actually only one purpose, as you correctly said, is changes to the real economy. But Janos, maybe over to you from your point of view. What is today's real definition of ESG in 1 minute?
Oh, that too. Great question there, guys. Great to be here with you today. ESG, I would say, is the latest manifestation of our quest to understand what is the impact of business beyond the narrow economic context. So in the past, you might have heard about this as corporate social responsibility, corporate citizenship, and so on and so forth. But I think that the latest naming, the ESG naming, which predominantly originated from ratings and rankings, right? It was a name attached to a data set, typically, but now has taken a life of its own. And I think ESG today is linked to this idea of how is it that companies integrate, account for environmental and social impacts at the core of their business model. And correspondingly, for the asset management industry, it's all about how do I evaluate whether companies are truly and competently integrating these environmental and social impacts into the way they do business. So in that respect, and I'll close on that. This is my 60 seconds up yet. So I think that ESG is yet another way of understanding, sort of complementing our understanding of business. In other words, next to financial data, which are typically backward-looking. So ESG is a way to understand forward-looking, intangible assets and the extent to which they synergistically work with a company's financial performance to deliver businesses that are likely to thrive 20, 30 years down the line.
Thank you so much, Johannes. And now let's say taking a look on ESG from a business perspective. For example, about 2 months ago, on the April the 30th of 2021, CNBC titled, "There is no hotter area on Wall Street than ESG," commenting on the record inflows in Q1 2021 of about 185 billion US dollars, which is 17% more compared to the last quarter of 2020. The demand especially is soaring across Europe, representing about 147 billion or almost 80% of the inflows. Just coming back to you, Jennifer, I mean, this sounds like really exciting times for the asset management industry, and you already gave some insights, but what you mind sharing a little bit more about what does ESG and the trend towards sustainability mean for you as an asset manager like JP Morgan Asset Management concretely? How does ESG already affect your investment decisions today? And let's say taking the other view, what recommendations you might be able to give to certain sectors which are particularly confronted with ESG, like energy, oil and gas? That would be interesting to hear.
Yeah, I think it has really caused a tremendous shift in the way we think about managing the, if you like, non-sustainable products, or our original investment portfolio that don't have a sustainable objectives in mind. But then also it changed the way we think about designing new sustainable products. I think in the first part, it's really around investing in data, talent, research, so that we can get our hands and access to better information that allows us to go beyond what company says, how they manage employees, how they make use of natural resources and their governance structure, right? Really tapping into multiple data sources and then using our own fundamental research process and doing a lot of deep dive engagement with companies on an individual basis to really understand all of these issues, and with the goal to effectively enhance risk-adjusted return. We went through, a pretty lengthy process over the course of 11 months. We evaluate every single investment engine to make sure that they are systematically making use of ESG information in every part of their investment process. So we looked at how the analyst is evaluating ESG, how the portfolio manager is changing his or her idea when he sees the ESG information, and then also how is that documented and monitored by our investment risk team. So and the reason why we want to do that and invest in technology to do that is we believe that these ESG factors are fundamentally material and they can drive performance outcome. The other area that I think really changed our mind around investment portfolio design is just thinking about the kind of investments that's needed in order for us to transition to a better future, right? Be it on the environmental side or on the social side. There are a lot of really exciting investment opportunities. So I would say that for sustainable products, we're definitely looking at a number of really interesting areas whereby we see new investment opportunities and technologies. And it's not just renewable energy, electric vehicle. In the context of, you mentioned climate change, right? There are so many other sustainable solutions out there in agriculture, in real estate, even in semiconductor, right? Every wind turbine has a chip, and that IP is owned by a handful of semiconductor companies. So I think the excitement is, how do we actually allow our clients or other investors to be exposed to these type of opportunities in a more systematic way, and then also to tap into smaller companies, because at the end of the day, as you alluded to, a lot of those flows were driven into companies that already have if you like, a pretty good names in the market for doing a good job on ESG. I think it was quoted in The Economist a couple of weeks ago that the risk of a ESG bubble is something that people are really aware of, because a lot of those new opportunities and technologies that we need to succeed don't really exist. The ones are held in the hands of a few companies, and their valuation gets driven up. So I think from an investment standpoint, we spent a lot of time in the last 6 months making sure that we are equipped to be able to find companies that are smaller, that may not be enjoying the same market cap as some of the other ones, but are doing very, very interesting research that can potentially be helpful to solve the world's problem. So I think it's really these two that's been driving the way we think about how we're redesigning our own process. The last thing I would say, I think the growth will continue, really. We may see a little bit of a bubble, but as more technology is being developed, you will see more capital directed to this space. I believe Bloomberg made a prediction that by 2025, which is not too far away from today, global assets under management, presumably 1/3 of that will actually be in sustainable or have a sustainable outcome embedded in that. That's very, very significant and very big change if you think about where we were 3 years ago. So more to come on that.
I fully agree, and I also think with more data to come and more availability of ESG relevant data, the trend will only more and more increase, and we may even over exceed Bloomberg's expectation for 2025. But we will see. Steffen, as you have quite recently moved from the asset management sector into insurance, what's the difference now that you are working for insurance compared to asset management? And what do you see in the insurance sector? What are, let's say, the biggest challenges you are facing when dealing with ESG in your day-to-day job?
So Olaf, first of all, thanks for that question. I'm still in both worlds, to be technically precise. So I'm head of ESG of an asset manager, Munich Reinvestment Partners, but also, of course, I'm living in a environment where sustainability and sustainable insurance is quite bold. And let me make this more precise. So Munich Re has defined an Ambition 2025 strategy, and this strategy includes dedicated sustainability objectives. And what the interesting piece is, since you ask, what does it mean for insurance and asset management, it encompasses sustainability goals that are both on the underwriting liability side and the investment side and on the corporate business side. So it's multidimensional. Yeah. Let me get a bit more precise. What does this mean? So within underwriting, for example, the goal of Munich Re is to decarbonize. Yeah, so it means precisely having a dedicated target to reduce thermal coals linked emissions in underwriting by 35% until 2025, and to phase out coal emissions in underwriting completely till 2040. Yeah. But it's on the underwriting side, the interesting piece, since what's this is defense, so to say. This is to mitigate physical climate change risk, which we already see. And by the way, Munich Re has 4 decades of experience with physical climate risk, being a reinsurance company. So we have tons of proprietary data. Yeah. So what does it mean on the offense side? Because decarbonizing is important, but you got to provide solutions. So it's also providing green insurance. So it's concretely to insure on and offshore wind parks, but also new technology like batteries, which then makes it interesting from an investment perspective, makes those projects and infrastructure investable. So this is on a few targets on the liability side. Let me get to the investment side. So there you have to differentiate the insurance assets of Munich Re and also the assets managed on behalf of third-party clients. Yeah. On the insurance assets, which are roughly 200 and more, a bit more than 250 billion euros of assets, Munich Re has joined the Net Zero Asset Owner Alliance. Yeah. So joining a group is one thing, it gives an important signal together with other insurance companies, leading insurance companies, but delivering is important. Yeah. The plan of Munich Re is to decarbonize listed equities, listed fixed income, and real estate by -25 to -30% until 2025. So, and then over time until 2050, make the investments climate net neutral. Yeah. But also here, it's defense is decarbonizing. Offense is enhancing the green share. So within the portfolio currently, 1.4 percentage points of the asset allocation are in green assets. That means renewable energy infrastructure or green bonds. So within renewable energy infrastructure, the goal of Munich Re is to double that within 2025 time period. Let me get to the last point since it's holistic. The corporate objectives is to decarbonize the carbon emissions per employee. So concretely, there was a huge decarbonization in the last years, and now the last end to get climate neutral means that there's a dedicated decarbonization target in place per capita, which means -12% technically until 2025 versus 2020. So all these things are happening now. The investment side is also reflected. You know, so what does it mean? So this is existing business. Munich Re Investment Partners is a new company that's being set up. And right from the beginning, we said sustainable investment as part and parcel of our strategy. So we are building rules-based strategy. We deliver together with our colleagues from Munich Re Markets, reinsurance solutions and investment solutions for insurance companies within Munich Re and outside of Munich Re. So it's integrated right from the start. So I stop here because you asked to be sharp in time.
But thank you so much for sharing these insights. It's really interesting to hear how Munich Re is organizing this.
Sure, my pleasure.
But now turning over to the US and Merzat, now we have heard a little bit more, or the focus was a little bit more on the European perspective. But would you mind sharing your views with us? What's the US perspective on this development? And asking a bit more concretely, is the US financial industry probably missing out on a business opportunity here? And what do you think, what will it take for the US to picking up the pace?
Thank you very much, Olaf. Appreciate it. Yes, I will start by giving you a feel for a general feel for where we are. And the way I would explain it is that there is so much interest, but with so little understanding about the whole ESG environment. It's a major undertaking. It's a major market, and the amount of understanding, the standards related to that are not on par with other factors that we deal with, like style or value or such a thing. So a lot of times what we see is that ESG has collapsed into, for example, carbon counting, which we all know it's a heck of a lot more than that. So that's one general statement that we can make. The other one is the question of data. Overall, I think the data for ESG, I've been looking at data quite a bit in terms of data science and technologies. I would say the ESG type data, the duration is short. So the amount of back testing that we can do to come up with different technologies and different portfolio structures are limited. So you can play with very little data and then come up with a method that produces ESG alpha, but I would be very skeptical of those that talk about strictly ESG alpha, especially in the short term. So I think that's another very important point that that I've observed. And the third item is there are very few data providers, and the correlation between those data sources are not as good as you would expect. So it causes more confusion from that point of view. So, but it's clear in the US and North America, there is a large momentum, a lot of interest, and it behooves us to really better understand the whole ESG area. A lot more research is needed to clarify all the nuances of ESG. Otherwise, we run the risk of a lot of confusion in the market, and things are not matching up to what the investors are looking for. The second item, and I will be quick about it, and then I can answer questions as they come up, is the status of regulatory environment in the US. As you know, as of last summer, Department of Labor through ERISA has limited returns that are dependent on ESG. So that goes negative for ESG. So returns are not subordinated by ESG. So that's, take that as on one side. But the new administration has started a huge amount of activities in ESG and the regulations in this area. The focus is on climate change, and the thinking is that the climate change is the most existential part. So most of the regulation are more targeting towards the climate change. Amongst the departments are ESG, I'm sorry, SEC, which is requiring now climate disclosures. We have Treasury that are looking at climate risk versus financial stability, and FDC that is initiating quite a bit of activity in connection with the banking sector and to incentivize carbon prices in the market and disclosures and taxonomy. And at last, the good news is that the US has joined the Paris Accord, and that will drive a lot of the ESG activities in the US. I hope it wasn't too long, but back to you, Olaf.
Absolutely not, but please.
Yeah, Mehsad, so this is Carsten speaking. I would have one question. Maybe it's simple. See, the European Union was keen on issuing a sustainable finance strategy and will update it very soon. So do you have a notion about the US administration's plans on doing a similar thing?
Yes. So the Treasury is doing the climate risk versus financial stability. There is a report out due November of this year. FTC is continuously working on new regulations. So, and there is one report out already, about a couple of 100 pages, on the regulations regarding climate change and incentivizing markets for carbon pricing and disclosures. So So all of those things within this year, you will see a lot more new documentation on regulation putting out forward.
Thank you very much, Merzat. And again, your answer, tees off basically the next subject that we wanted to cover here. And Carsten, also your comment or additional question does this very well. So focusing a bit on really the green regulation in the EU, without being technical, of course. Yeah. But one of the goals of the intentions of the SFDR and the taxonomy regulation is to sort of avoid or counteract greenwashing. Yeah? And this is of more importance as we are seeing now the market going into a direction where more and more products will simply qualify as Article 8 and 9 products, but in particular Article 8, then I think earlier expected when this first came out. So everyone wants to be in that category. Now we have also labels, yeah, and actually there has been some communication today that IOSCO will publish guidelines for ESG ratings, also quite interesting. But maybe a question to the investment specialists, and starting here with you, Steffen, but it's also goes, I think, to Jennifer and to Jonas. What are your experiences currently in this respect, but also where do you see the industry moving to?
Sure, Harald. I mean, that question is absolutely important, you know, since, as you say, you know, on the one side, we see a lot of money being invested in sustainable investing products. A couple of figures were mentioned. I would add 70% of inflows into ETFs and sustainable mutual funds outside of money market and commodities last year in Europe were allocated in sustainable funds. So 70% is more than 2/3, right? So you can see, like, every week new sustainable ETFs and funds being launched. Sustainability indices is the fastest growing subgroup of investment indices globally, right? So there's a lot of product launches, product innovation, repositioning of products, and the big question is, you know, how does that match the interest of the regulators that the investors are not greenwashed? I would simply say, you know, some basic principles. Yes, it's very important to understand those regulations. Yeah, without understanding those regulations, it is hazardous when you're in sustainable investing and part of an asset manager, head of ESG, to launch a sustainable investing product. So you got to understand what's happening in those regulations, whether it's the Sustainable Financial Disclosure Regulation and Taxonomy Delegated Act in Europe, but also it goes to Hong Kong, it goes to Singapore, it goes to Australia, and as we heard, like, you know, likely also going to happen in the US. So wherever you are, you got to understand what are the rules, right? Personally, you know, what I see is quite important is also as a provider, you have to define clear rules, what kind of strategies you think are sustainable and what are not sustainable. And in doubt, maybe just say this should be rather a non-sustainable fund, right? It's difficult probably to downgrade a product that you have positioned as an impact strategy at, say, intervention of regulation. And as we can see, like actually the US, the SEC, early in 2020, started to pick some of the supposed to be sustainable funds and looked into the marketing material and into the underlying investment fact sheets and whatever material had, and they were not shaming those providers, but clearly talking to some of the providers from what I've heard. Yeah, same thing is likely going to happen in Europe. So you got to be prepared for say what comes after the inflows, and that's why you need clear rules. And then to wrap up my message here, what's important, for example, for us as Munich Green Investment Partners, is to be brutally honest on sustainability, because sustainability, as we heard, you know, it's not so easy to say it's digital, this is sustainable and this is non-sustainable. Yeah, in very rare cases, this is this case, but you got to have some rules. And I think one of the rules is you got to be consistent with what you're communicating to your clients, whether it's in marketing material or pre-contractual information or actual contractual information, whatever is the investment sustainability promise needs to be in the fund with clear binding investment rules and needs to be disclosed, full stop. And why do I like this principle? Because I'm a bit allergic against having a regulation that prescribes me exactly 80 or 90% of your funds has to be in sustainable assets. And by the way, you cannot buy this and you have to exclude that and you have to stick to that rule and that rule. This is not how I look at innovation. And for me, sustainable investing is innovation.
Yeah, no, thank you for that insight. And I think also it's about disclosure. Yeah, the rules are about disclosure, but still you have, as an investor, the freedom to choose. But I mean, whoever says something needs to deliver on it, on the website disclosure and the annual reports and so on. Jennifer, I mean, that was obviously quite a comprehensive view from Steffen, but I'm sure you have something to add.
I couldn't agree with Steffen more on how if the rules are too prescriptive, you really killed innovation, and I think it's a shame if we lose this opportunity. But I also think that what the regulation is trying to address are two things. The first one is, in the old days, a lot of the sustainable products are effective. If you look under the hood, maximum they only apply a number of exclusionary screens. And I think a lot of clients or investors are coming to the realization that, okay, if you have a portfolio or a fund product that excludes 3 sectors, can you really call it sustainable? You still have investment in companies that may not be treating employees well or have human rights issues in their supply chain. So I think that's what the regulation is shifting towards, i.e., like you need to have some minimum thresholds on standard E, S, and G issues, no matter how many screens or exclusions that you apply, or if you have a environmental or social objective or not. I think that's great, because that is really what was lacking in some of the older version of sustainable products. The other thing I would say is that some of the existing or older products, they are effectively built by rules-based technology, or like Mezat said earlier, a lot of those third-party ratings. I think the challenge there is that these ratings are built based upon potentially inadequate data or poor data quality with very low track records. And so it's a little bit of, in some cases, you can end up in a situation whereby you have garbage in and garbage out. Even for us doing day-to-day investment, at JP Morgan Asset Management, we don't really look at third-party rating that much, right? We use it as a point of reference, but what really interests us is the actual raw metrics, right? What we want to understand is how much carbon a company is emitting. What is the scope 1, 2, and 3? We want to understand how much water they are consuming, what is the recycling ratio, the withdrawal ratio, etc. That's the kind of information that's interesting and actually important, and we can use to build into our valuation model or credit rating model. So I think the other thing what the regulation is hoping to address is effectively push for not only you have to provide disclosure at the impacts that the end portfolio may have on key environmental and social issues, but also you want to go one level beyond just standard ESG scoring, right? Really looking at what are the most important metrics and link that clearly to the outcome that you're trying to achieve. So all in all, I think the intent of the regulation is great, but having said that, I think we all suffer from so many different terminology, Article 8, 9, 6, and then also there is still a lot of unclarity on the underlying rules. And some of you just mentioned that in Europe we have all of these different labeling systems. It is a very chaotic market, I have to say, to operate. To be a product designer is difficult. To be an investor, I think it's actually a pretty good time, because companies that you're looking at, like what I do day to day, they're under a lot of pressure to disclose more. And I also have a lot of tools to be able to better understand these assets that I'm investing in. So there's pros and cons, but we are in a very, in my mind, chaotic and interesting time.
Thank you. Yannis, from your perspective, is there anything to add? In particular, I would be interested on your view on the external ratings that are out there.
Yeah, absolutely. So let me add a couple of different dimensions here. I think that, believe it or not, there is a silver lining to greenwashing. And that silver lining is the fact that why would these funds or why would these companies feel the need to greenwash? It's because everyone cares about these issues. It's because these issues are so important and they feel the need to sometimes lie their way there, right? So that's the silver lining. I mean, it would have been much worse if they didn't even care about these issues, right? So I think it's a misstep, but a misstep in the right direction in that effect. Now, on the issue at hand, I think that let us not forget that, you know, the whole idea of bubbles and passing fads, it's not particular to sustainability. I am pretty sure that every single company website that you visit these days is going to tell us something about big data or AI, even though what they actually do has nothing to do with big data and AI. It's an equally equal pressure, if you like, to be seen to be doing something without necessarily doing something. That's fine. We know how to handle this, right? And I think in the grand scheme of things, that's a good thing because, like Jennifer was saying, it's pushing, in this case, the asset management industry to develop the methods, the tools that it needs, even the technologies that it needs to see through the noise. And that's it's a very important capability to have. So you can always see the positive side of things. Now, the other thing that makes me extremely, positive and optimistic is that slowly but steadily we are bringing putting together the right social institutions to monitor for greenwashing. We've heard from Eckhart before about, you know, what the SEC is doing, what the regulations are doing, and so on. Of course, I understand that if you are an investor, this is the messy middle. This is the period of turbulence, if you like, before we settle. But let us not forget, it took us 100 years to arrive at financial reporting standards. The term ESG did not exist 10 years before today, right? So painful and noisy and complex as it is right now, it is a frustrating but necessary part of the process so that we can eventually agree to a set of standards so we all know what we're talking about when we refer to these metrics. I'm also encouraged by the fact that we do have other social institutions. For instance, we know that NGOs like here in the UK, Share Action, they hold accountable this entire asset management industry. They tell them, okay, well, you know, your website looks like Greenpeace. Let's see how you voted on climate change resolutions. Does the rhetoric match the voting record? That's accountability, right? Let's see. Well, again, you claim to be, you know, this green bank, for instance. Let's see how many fossil fuels are you financing, and how many fossil fuels do you plan on financing? So those institutions exist. They bring about radical transparency, and that is, at the end of the day, the antidote to greenwashing. The last thing I'm going to mention is that let us not forget that this is not exclusively a measurement issue, right? It's not that there are ideal metrics if only we could find them. It's not that we have 100% sustainable companies, right? We are going through an equally experimental period in terms of the underlying corporate practices. What may be good metrics today, it might well be the case that they're not good metrics tomorrow. Why? Because of two reasons. First of all, profound underlying experimentation by the companies in terms of integrating and addressing the environmental and social issues. And there's a long way to go, right? We talk a lot about climate. That's, in my humble opinion, clearly an existential issue, but only the tip of the iceberg. Wait until we get to social issues and social inequalities within and across countries and so on. That's where the difficult part starts, right? And so this is not just a measurement issue, it's also the underlying experimentation of companies that's very important. And the last thing I'm going to mention is that, you know, these are dynamic issues. Unlike financial metrics, these are dynamic issues. And let's be honest, as a society, right, especially in the developed world, we almost did not care about diversity before. We didn't care about gender pay inequality and all those things. In other words, there is an emergence of issues, there's momentum of issues. So no matter whether we talk about standards or metrics and so on, we need to allow enough flexibility for these metrics to be more dynamic as issues emerge or as issues gain momentum within society.
But that's a very good point, Janos, because actually, if you say it's dynamic, but of course, regulation and the role of governments, yeah, is really always sort of following the dynamic and being a little bit behind the curve, of course, because they are reactive in a way, but then time has moved on already. So perfect tee up for you, Carsten. How do you see the role of governments and supernatural bodies to sort of be on top of the game?
Yeah, that's a, to be honest, that's a very good question. As we see kind of communicating tubes to some extent. So from what I can see, and that's based on past experience, that there are some first movers, and those first movers can be located in the private sector as well as in the public sector. So what we've seen, for instance, in the private sector is that, in particular, some maybe more bold in investment institutions, asset owners, with a special mandate, moved ahead quite early, just started experimenting, basically. So that's what we've seen in the early days. What we've seen as well is that some governments, with an emphasis on some, started experimenting as well. So let's recollect the French government experimenting with this paragraph 173 that related to additional transparency very early on, a couple of years ago, for larger asset owners. And we've seen more recently experimenting in the Netherlands, for instance, where the central bank started with scenario building around climate. We've seen much earlier experiments in Sweden and in France alike when it came to managing equity portfolios more sustainably. So there's quite some activity there, but then, and that's an important aspect as far as I can see, the European Commission took over initiative around 2018 insofar as it came up with its redirection of financial flows plan, action plan on promoting sustainable growth, and it's based pretty much on transparency in the first place, on better representation of risks, avoiding of greenwashing, certainly, where the consumer perspective comes into play, and more long-termism. And in that sense, then the public sector took the lead, and in particular the European Commission did so. So we're just in a phase where it's still kind of, at one point, public sector goes one step ahead, and then private sector moves on, and in particular looking for solutions. As Steffen mentioned earlier, the Asset Owner Alliance, Net Zero Asset Owner Alliance, we've seen now something similar in the banking sector emerging, and there it's about solutions. And solutions is the name of the game right now. So we can have whatever regulation, practice, and then implementation within financial institutions is the key of the game. In that sense, yeah, there's some early movers, and that's good. And maybe, say, now having a bit my German perspective, it's something at least we in Germany could get a little better. Just being a bit more bold, as we have a strong industrial base, we have a large SME sector. So there's some specificities that we can bring to Brussels easily.
Okay, thank you so much, Carsten. Just once again, going over to you, Merzat, in the US. Having heard what Carsten just said, would also be good to get the US perspective on this. I mean, you are talking to so many US banks and asset managers. How do they see ESG, and also, let's say, what is the upcoming regulation? You briefly already touched on the new Biden administration, which is already changing the pace. Can you give us some more insights there?
Yeah, sure. So I think in the US, there is, and I don't mean to be negative, but there is a level of confusion because things are in the state of flux in terms of lots of different regulations that are coming to fore, and it takes time for all these things to take effect and become really deployable. So we have heard from FTC commissioners, for example, the concept of flexible and interactive type of regulation. So they realize the technology is moving fast. I think one of the panelists mentioned the role of data science and how data science is moving and how it interacting with ESG development. So there has to be a way to do regulations that is a lot more interactive and a lot more flexible to respond to the movements in the market. And I also see a lot more emphasis with the banks and actually more with the investors about the transparency. So there are lots of different ways of analyzing the ESG data, back testing for a short period of time to come up with the answer that you may really want. But I think I hear a lot more about transparency, asking a lot of questions as to how you arrived at this type of rating. And I also see a big role in the education as to what it is and understanding what it is you're getting into on part of the asset owners. And I see both of those things happening here in the U.S. In a big way, which is really a good sign.
Thank you so much. And Jennifer, may I turn once again the table to you? Can you give us a perspective of what's happening in Asia? Do you see also what is the trend happening there?
Yeah, I think Asia is actually moving very quickly. If you think about where we've been in Europe over the course of the last 5 years with regards to green regulations, I think Asia on the one hand is effectively looking at the lessons learned from Europe. So now the way they think about regulation is that they want to work or launch regulations in parallel track, which is on the one hand, you have clear guidance on the capital allocation side and product labeling, but then also on the other hand, making sure that at least mandatory company disclosure on important ESG information is also being launched, such that when the two come together, then you will be able to effectively really transform the ecosystem in a more efficient and effective way. So I think that's really, really good. The other thing I would say, just by our day-to-day talking to companies in Asia, two things are really emerging, one of which is what's happening in Europe with carbon tax and cross-border adjustment tax. That is really, really on the top of mind for many, many Asian companies. As you know, they rely a lot on the European market for export. This will have a fundamental impact on their businesses. So we're definitely seeing corporations coming to their local governments advocating for either similar type of policies, but more so really just action, right? Need to step up the game and making sure that companies that reside in Asia, for example, do not suffer or effectively lose their competitive edge as a result of regulation in Europe. I think the other thing that's also emerging is that in some countries in Asia, there is actually, we talk a lot about digitization and use of social media, et cetera, e-commerce. If you look at it, and this is nothing new, right? Digital penetration in many of the Asian countries is far more than in some countries in Europe or even in the United States. So from an investor standpoint, what can you do with that massive amount of data to try to better understand social problems to try to better understand company behavior is really, really exciting. Give you an example. We use one of the data source that we use to get a better understanding of future potential controversies with companies is NGO data. And what we have found is that the level of content, or the content quality of the data or reports from NGOs and the topics that they're covering is really expanding. And I think that reflects how, from a society standpoint, there is a much better recognition of, be it environmental issues or social, issues are real, and that that they actually focus on that a lot more, but also on the company side as well. So I think all in all, we're definitely seeing regulations moving very quickly, but also much better recognition at the corporate level, wanting to ensure that they don't lose the competitive edge. And then at the end, last but not least, from an investment standpoint, how can you actually make use of that vast amount of data to better understand what is going on locally?
Thank you so much. And turning to, let's say, a different perspective, Johannes, we have now heard more the geographic development or the geographic differences when it comes to ESG. But I think also what Jennifer just said in terms of analyzing social data, what's your view? I think the public demand for ESG products is soaring, but do you think this demand is also driven by, for example, a generation gap? For example, is Generation Y or is Generation Z asking for more sustainable products compared to previous generations? Is ESG also a generation topic?
Absolutely. I think without a doubt, we see a radical generational shift here. And what is important to note, I think, is that if you consider millennials and Gen Zs, they have a multiplicative role to play in this. First of all, because they function at the level of products and services, in other words, in product and services market. And therefore, they demand more environmentally and socially responsible products and services. So that's a very important one. Second of all, labor markets. They vote with their careers, essentially, right? We know that they choose their employers, the companies they want to work for based on an alignment or a potential alignment between their own personal values and goals with those of the companies. And forget not, if you are employees, then they also see what the company does or does not do from the inside, right? And therefore they can create even further accountability in that respect. And last but not least, it's also coming strong in the investment industry, right? We have intergenerational transfer of wealth from high net wealth individuals, and we also see the younger generations through their pensions and their pension savings and how they demand that those are also invested according to ESG. So already we can see product and services markets, labor markets, as well as capital markets feeling the pressure for these young generations. And I can tell you that I see these on a daily basis. I've been at the London Business School for 12 years now. When I joined, I always taught this class on business ethics, and I wanted to do the rather banal discussion between Friedman versus stakeholders and so on, and you could always find students to defend either side. Nowadays, it's extremely difficult to find anyone to sort of defend the more short-sighted, myopic, profit-only model of the corporation. So I'm now skipping that debate because it's rather obvious. So we have seen that shift as well. The one caveat, though, that I would want to note here is that companies should not, just because this shift is happening, companies should not outsource the problem to these new generations. In other words, if you're a company that produces a green product, let's say, but it's actually more expensive, you cannot just sit and say, I'm just going to wait for them to educate themselves and start and pay more to buy my product. In other words, the fact that, let's say, ethical consumerism is on the rise does not mean that companies should not innovate in order to give us products that are great products at great prices with limited or no negative impacts and arguably even positive impacts, right? So the onus of innovation is still on the companies themselves. And that is the challenge, I think, for the asset management industry, because of course, most companies are going to comply up to a point, but you don't invest only in the middle of the pack. You also need to find the outperforming companies, right? And the outperforming companies are the ones that go, beyond compliance.
Thank you. Johannes, you mentioned risk here, I think, a little bit, and reward, yeah? And I think that's a very nice tee up again for sort of Steffen, and I want to go with you first, but also would then be interested to have Jennifer's view. By law, asset managers need to act in the best interest of the client, and traditionally that was a risk and reward profile. Now we have ESG as an additional, let's call it dimension. It's probably untechnical, I'm only a lawyer. But what is your view? And just give me 1 second, because I want to integrate a question we just received from the audience in that question, because it very fits well with that. So what is your view on that? But the question is, how is your view on investments in emerging markets with a view on the higher risk, of course, higher ESG risk, but obviously in many times also promising, of course, higher returns?
Thanks, Harald. Yeah, that's the trillion-dollar question. You know, how does sustainability convert into outperformance? Well, for us at Munich Re Investment Partners, it's really about balancing risk, return, liquidity, and sustainability impact. Yeah, it's this equation that gets enhanced. It is not one for the other. In the optimal case, it's reinforcing positively, and we see a number of good evidences where it becomes positively reinforced. Having said that, of course, it is not a self-fulfilling prophecy. You know, some of the co-panelists mentioned some examples. So blindly running into sustainable investing assets is also not the right thing. Yeah. So as you say, you got to act in the best interest of your client. Let me make it more precise. Take it down from 20,000 feet to basics. One of the best performing sustainable investing asset classes, according to statistics last year's, were clean tech ETFs. Right. When you look at the ETF and mutual fund performance league tables, they were on top. On the other hand, when you look at the underlying valuation of those corporates, they exceeded valuation levels of the freaky days of .com bubble back beginning of 2000, you know, where online pizza delivery was more worth than Metro, right? And surprise, surprise, it didn't work out positively. So as I said, like, it always comes back to risk, return, liquidity, and balancing impact. I think in the end, my and our experience is that certainly, you know, when you think about it from an investment hypothesis or investment assumption, that's also pretty important about sustainability. You got to build some assumption, because one colleague mentioned before, you know, we got very short time series on sustainability data. And actually, the question is, how much should you rely on historic time series for deriving investment performance assumptions going forward, right? In any case, whether with or without ESG. But sustainable investing is a lot about identifying as those winners, those corporates that transform into a sustainable business strategy, but also, of course, are profitable. Both needs to go hand in hand. So it's more like about translating that into an investment strategy to optimize the risk return impact dimension. Now, emerging markets, certainly a lot of the future of this planet in terms of whether we're gonna win and make the planet a more sustainable planet and then relieve stress from planetary boundaries that we have increasing is certainly interesting from an investment perspective. So when you say, you know, what's a view on emerging markets and sustainability, obviously it's highly interesting to look into you know, what defines sustainable corporates in emerging markets, what kind of underlying technologies are required in emerging markets, and it is growth markets, right? So it's as much as finding those winners in those markets and those solutions that are required for those markets, as also avoiding risks to a certain degree, and then make it more precise again in terms of assets. So I haven't looked at the latest analysis, but emerging market equities actually was one of the asset classes where sustainability integration whatever that means in technical investment strategy details, delivered best outperformance versus non-ESG market benchmarks. Why? Because the dispersion of corporates is quite high in terms of sustainability integration into business strategy. But having said that, certainly there's also a lot of impact investing required in emerging markets. That's where the biggest population growth happens globally. We're moving to 10 billion globally till 2050 or so, and quite a big figure. Those countries are adopting Western lifestyles. Again, fully understandable, fully desirable, but it has a question: what does this mean for the planetary footprint? In terms of carbon dioxide, but also in terms of deforestation, in tons of questions, access to water and so forth. So you gotta have a lot of innovation in that southern hemisphere or wherever emerging markets are located, and it's a big investment opportunity again. But to answer it, yes, it's a big investment opportunity from a sustainability perspective.
Thank you so much, Jennifer. Over to you.
So I actually think that if you think about emerging markets, especially, ESG is more important than ever, because ESG really allows you to have a better understanding of the risks that you're looking at. So I gave an example earlier about using NGO data to stay ahead of the game before something, be it a violation of environmental regulation or mistreatment of employees or human rights issues, gets picked up by media or gets reported by police. To be able to identify such risks in the emerging market ahead of everything else is really, really important. And so I think the view really is looking at managing risks effectively. And also, if you look at some of the more macro issues, like for instance, a lot of those emerging markets are potentially more exposed to climate change risks from a physical standpoint because of lack of preparedness to adapt to these situations, right? So there is no doubt that you have to think about it through the lens of ESG to truly identify these risks. I worked on a project when I was at Asian Development Bank, and this was working in Central Asia, so all the ex-Soviet Union countries, about introducing renewable power, solar. And the questions becomes, or the idea became really, really absurd to a certain point, because you're thinking about installing solar power plants in places like deserts whereby there is no water for cooling purposes. And we all know that solar power plants need water. So what do you do in situations like that when you're not thinking about ESG issues holistically, but only focusing on, oh, that's a green investment opportunity, let's invest in that, without considering, only because it reduces your carbon emission, but without considering all of the other related environmental or social aspects of one particular investment opportunity. So I think in the context of risk management, it is actually really important. And on the flip side, I would say, moving beyond the emerging market globally, I would argue that if you stay invested in companies that are not willing to transition or are very slow to change their business practices to transition to a low carbon economy, that's very, very risky. So I think it's really that change of mindset. To Jonas' point earlier, the world is changing, right? Some metric may work for a certain period of time, but a few years later, we will be looking at different sets of risks and opportunities. So I think the beauty of ESG and sustainable investing is that it's taking a very forward-looking view. What are the new trends, new phenomenon, new data that's on the horizon, and how do we deal with that? How do we factor that into how we think about future performance of assets that we own?
Thank you. I think in terms of timing, we would like to jump to the questions that we have received, and therefore thank you so much already for sending in your questions. The first question would go to the direction of Johannes and Jennifer once again. And it is like, do you believe there should be some capital benefit for strongly ESG-linked products or portfolios, so incentivized by governments or regulators? Should this be a carrot or a stick from an economics point of view? What's your view on that?
Jennifer, if you are ahead, I can go up to you. I don't mind.
Yeah, so I think you actually need both. We've done the analyses last year looking at, for instance, taking a look at transition. and think about, you know, if policymakers take a carrots-based view versus a sticks-based view, i.e. by providing R&D and then also subsidies and incentives to green opportunity versus introducing carbon tax, efficient standards, etc. What we found is that there will be, even in the very short term, some degree of impact on GDP growth. But the best outcome is you combine both. And the reality is it's actually not possible to achieve where we need to be, i.e. net zero by 2050, with just one of those. So you really need a combination to effectively incentivize the private sector to come in and participate in providing capital. So I don't think it's a one or the other. It's actually a combination of both. I don't know, Jonas, if you have, if you share the same thoughts or have other comments on that.
I absolutely agree, Jennifer, and I'm going to let me add another dimension here. It's important to understand that we don't start from neutral ground. We start from a place where we're actually subsidizing the wrong direction, right? Whether you want to talk about subsidization of fossil fuels, even central bank neutrality has a disguised subsidization to the extent that it reflects subsidized industry. So before, I mean, in addition to the carrot and stick that Jennifer very rightly pointed out, first of all, we better get our act together in terms of what are we subsidizing in the wrong direction. And there's a lot of that we're subsidizing in the wrong direction, right? So I do agree on the complementarity approach. It allows for more flexibility, if you like. And to be honest with you, we are at a point in time when we almost don't have the privilege and the luxury of choosing one or the other. We need all of it, and all of it might not even be enough and on time, given the problems that we're facing here. We need to understand that everything that has happened in the last 5-10 years on ESG and climate in particular made absolutely zero difference, okay, on our carbon emissions. We're still increasing and moving in the right direction, right? So that is the benchmark. Right? That's how ineffective in the grand scheme of things it has been. So we better have all the policy options on the table and even more.
Shall I? Okay. So then, thank you so much for this. We would like to go ahead with Carsten and Steffen. And the question is, what does it really mean in terms of mindset needed to integrate E and S into a robust company's governance business model? And what do you think are common challenges and how can these be overcome?
Should I start? Very simply, first of all, commitment from the top. Sounds simple, but it's so true in practice. So your bosses need to believe in sustainable investing, sustainable insurance, as they do in Munich Re, for example. And without that, it's an uphill struggle. Second, education is key. So as mentioned, education about sustainability. It's a fairly short history, and you sit at a table and discuss about ESG. You use tons of acronyms, which is common in our industry, unfortunately. Later, people just walk away and say, did you understand what this person was talking about, really? So it is, you know, within Munich Re Investment Partners, for example, each week we sit together 1.5 hours and talk with everyone about sustainable investing topics, whether it's about climate, whether it's about, you know, performance and ESG and so forth. You gotta also engage people. That's very important. So don't think when you instruct it works. And in the end, also, what I think is important, use it as a source of innovation, look for solutions. It's so easy. Perfection is the enemy of the good. While you got to be, as I perfectly believe, totally, brutally honest, what sustainability, what you're talking about, and what is not sustainable. I think you got to find solutions, and you got to build products out of it. Yeah, so sustainable investing products in this case, in my case. That's where it gets concrete, and that's where you, from all this high-level talk, you got to find solutions, whether it's limited data or what to do with ESG ratings from external providers and how to enrich that, maybe through Munich Re in-house data or through AI, ML techniques and so forth. So, but in essence, in a very short answer, it's a combination of those things. So it's winning hearts and minds. It is top-down commitment, and it's engaging. Yeah.
There's maybe one or two further aspects I might want to add, and that is that these along the value chain, there's quite some strong push. So if kind of the very large companies, non-financial companies, start embarking on the sustainability way, then the entire value chain will have to move. So that just naturally. So that's one thing. Second, tone from the top, absolutely relevant, and qualification on every level. Starts with the top management, having someone in the executive board, supervisory board, taking responsibilities is really key. There's one aspect that I tend to miss in all this, and Steffen already alluded to it, and it's kind of making a business case of it, because that's a key feature. So if it's not a business case, it won't happen. So in order to make it a business case, there needs to be quite some good understanding, and there this qualification understanding comes in about what the world will potentially look like in 2 years, 3 years, 5 years, 10 years, kind of a planning horizon that is maybe slightly longer than currently. And having this kind of future-proofing of a business model is, in my perspective, the essential part, and that kind of bringing it back to the financial sector, to what happens right now, is maybe a little overlooked in terms of that it's important to think about not only the clearly green space like renewables, but it's very important to look into heavy industry, kind of polluting industry right now. What can be done to support kind of the change that is imminent? So to support the investments that are required to move from status now to the envisaged status. And that's a big business opportunity for financial institutions as well. So it's the investment institutions. In large infrastructure investments, we will have to do those everywhere on the globe, and it's the same for banking institutions. And kind of with the regulation that we are currently seeing, it tends to have a focus on the green space, whereas I would like to define green a little broader. Say if the ambition is sufficient to get out of, say, more harmful activities to decently green activities, that's actually why the music should play.
Yeah, I forgot this about budgeting. You're right. I mean, you got to have money to invest and deliver and build a business case. And that's very practical. Without a business case, you will not get the budget, and it's very hard to move on.
Yeah, exactly. I think we have a few more minutes left, and we see that we still have a lot of attendees on the call. Thank you for staying with us. And we have a very practical question, and this goes to Jennifer. Jennifer, acknowledging that you gave a very good example on the solar panel manufacturers and the usage of water, how does one monitor the do not significantly harm notion of the taxonomy within the overall ESG theme?
This has to be the most difficult question of this entire conversation. We all in Europe are trying to figure out PAIs. Oh my God. I think it's difficult because number one, a lot of the data that we ideally want to have is not readily available. And it's not only a question of companies' disclosure, because if we're thinking about the impact, they disclose something that's just a quantitative data, we need to translate that into actual impact, right? If you think about it in an economic analysis term, like what we did at Asian Development Bank, you need to be able to translate, because company does X, this could potentially impact or result in economic value, loss of economic value in this particular neighborhood or communities. That kind of practice is not something that we do in the investment management industry, right? This is not something that we're used to. So I think it's really two layers. A, the disclosure of some of those metrics that we would need is not largely available. And then secondly, we need to introduce a brand new practice maybe adopting some of the traditional economic analyses, cost and benefit methodology, introduce that into the way that we think about reporting to be able to truly quantify and do a very good job at quantifying PAI. So I don't have the perfect answer. I'm very optimistic about what's going to come next year when we all need to disclose PAIs and companies also need to disclose certain metrics. I think it's going to be an evolution. We will not be able to get it right away, but I think we will get there because it's important, right? That's what the regulation is about. It's not about whether you exclude X, Y, and Z. It's about what you ended up investing, what stays in the portfolio, what is the impact on the environment and society.
Thank you, Jennifer. And I mean, this question obviously was not fabricated before it really came out of the audience, and I was well aware that it's very difficult to answer. So thank you very much for your great answer. Olaf, do we want to close since we're on time, or do we want to give someone else of the panel the opportunity to comment on that?
Any other comments?
Yeah, it's a tricky question. Say there's the PAI, the principal adverse indicators, but then there's the taxonomy and the do no significant harm concept of the taxonomy. What is slightly different? Say one is more kind of company minded, and the other one is economic activity minded. What in itself is a slight difference. Maybe with some companies it's the same, but then okay, it's not that much diversified companies. With the DNSH relating to the taxonomy, that's my personal view, is I'm very convinced that financial sector people won't be able to analyze what there is unless it's very obvious. No? But say this has and will have to come from companies. And then the big question mark is around, okay, say it's kind of a self-reporting. What's the quality of that very reporting? Say we'll have to see what in what way this is going to develop. That's my message.
Thank you so much, Carsten. And it would be a big pleasure to answer even more questions, but I think we are now right on spot. And therefore, please let me briefly summarize some of the key insights from our discussion and the Q&A session today. I think what is absolutely crisp and clear, ESG is here to stay, and it will only get more important from a public, but also from an economic and governmental perspective. Furthermore, environmental, social, and governance is affecting the entire financial industry. What can be seen today is already a spillover effect into the real economy and the real world we are living in. We are at an inflection point, and ESG will change how we assess the economics of an investment. It will change the risk analysis, and it will change the risk managements of banks, asset managers, and insurance companies. In order to take informed decisions and meet regulatory requirements and to stay relevant for your clients and stakeholders, I think it became clear data is key. And what we learned during the session, I think ESG is absolutely a measure to influence companies, to learn more about companies. But, and I think Johannes said this, the metrics will change over time. How do we see the behavior of certain companies? ESG will much broadening the understanding of companies compared to the past. And an important message probably towards the regulators. On the one hand, regulation it is good, but on the other hand, it should not kill innovation because we see lots of innovation coming over the way. And finally, I think this was the last point. Whatever is done in terms of ESG, obviously a business case is also needed to make it clear that there's also an economic benefit at the end of the day. I think overall the discussion today showed the importance of the financial industry as we are at the start to define the future of sustainable finance. I think also on behalf of Harald, I would like to say a very big thank you to all our panelists, Jennifer, Johannes, Carsten, Mersat, and Steffen, for being with us and sharing your views on ESG. I would also like to thank you, our esteemed guests, that you are joining the webinar. We are all looking forward to welcome you again in our next global ESG webinar, which we will more focus on data, and this will most likely happen in September or October this year. With this, thank you so much for making yourself available, and have a great day, everyone. Thank you. Thanks.
Thank you.
Thanks for having us.
Bye.